Worst mistake is you've owned a great company and you sold it too soon.
Great investor François Rochon on the companies he is holding for exceptional returns.
Funding provided by ClearBridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Miller Value Partners, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of WealthTRACK. I'm Consuelo Mack. Most of our guests over the years are ones that I have known personally through my career in Wall Street as a journalist at the Wall Street Journal, CNBC, and here on WealthTRACK. But a few have been recommended to me by other journalists or guests. Such is the case today. I recently interviewed William Green, a financial journalist and author of Richer, Wiser, Happier: How the World's Greatest Investors Win in Markets and Life. It's a terrific book about outstanding investors, several of whom I have interviewed many times. You can see my two-part interview with Green on wealthtrack.com. Now, one of the investors he wrote about was François Rochon, a Canadian investor running his own independent firm, Giverny Capital, which has an impressive long-term track record. With about $3.65 billion in assets under management, Giverny concentrates on about 20 to 25 companies it deems high quality with sustainable competitive advantages that it intends to hold for the long term. Since this is his first appearance on WealthTRACK, I asked Rochon to share some of his history. Why did he establish his own firm, Giverny Capital, in 1998?
Well, I had this big passion for investing in undervalued securities in the stock market. I was very much influenced by Warren Buffett, and I could not really find a company I could work with or in which I felt that the investment philosophy was totally in sync with my approach. So I decided to start my own firm and use Warren Buffett's teaching to manage money for clients, which I labeled partners because we're really in the same boat. I decided from day one to just purchase for clients the same securities as my own portfolio.
And the name Giverny Capital, that Giverny, of course, was the home of the wonderful Impressionist painter Claude Monet. What is the connection or significance of choosing the name Giverny?
Well, when I was young, I went to Giverny to visit, like you say, Claude Monet's village where he lived for the last 40 years of his life, and that inspires so many of his late canvases. And when I went to visit Giverny, probably in 1990, I thought it was the most beautiful place on earth. I thought the water lilies were fantastic. I loved the gardens with the roses and the hollow trees. I decided at that point, I had this dream that I would build in Quebec, in Montreal, a similar garden, a similar beautiful place where there would be a museum with artworks and beautiful surroundings with flowers and water lilies. So I realized pretty quickly that I wouldn't need to get rich. So I thought it over, and I thought the stock market could be a good place to achieve that goal. I knew almost nothing about the stock market then, so I read every books I could find. Ben Graham's Intelligent Investor and Peter Lynch, One Up on Wall Street, and pretty quickly I discovered Warren Buffett and Berkshire Hathaway. So at that time, that was before the internet, I sent a letter to Omaha and asked if I could get all the annual reports of Berkshire. And Warren Buffett sent me this big package of all the annual letters. And after reading that, so we're probably early 93, I said, this is what I'm gonna do. I'm gonna invest in the stock market using Warren Buffett's teachings.
How much of an art is investing, and describe how you go about it?
Well, I would say if you want to build a great art collection, you have to look at a lot of art. So you try to find the masterpieces. And I would say that when you try to build a portfolio of companies to invest in, you should have the same process. So you look at every company. You study the history of capitalism, what works and what doesn't. You'll see there's been many fads that have come and gone, and as happened in the art history. I try to look at hundreds and hundreds of securities all over the world and try to find the 25 that I think are really the best companies to own. The last part of that process is really try to value the companies and try to purchase them, ideally well below the intrinsic value, so you have a margin of safety, which was Ben Graham's idea of the cornerstone of intelligent investing.
You describe the companies that you look for as being high-quality companies with a sustainable competitive advantage. When you started investing, it was really before the internet. You told me in a phone call that you actually start with value line, right? Is that where the search began, at any rate?
I think there's 1,700 companies that are followed on a quarterly basis. On a one page, you almost have all the information of the last, let's say, 15 years. And it's very, very well done. I look for certain things. So I'll look quickly to the return on capital, the growth in earnings per share. Have they issued a lot of shares? Did they buy back shares? Of course, I'll look at the balance sheet. Do they have lots of debt? And I would say in 5 minutes, you can have at least a general idea. Is this the kind of company for me or not? It's not the end of the process, it's just the beginning, but I think it's the first filter, and I've been using that since day one.
And over the years, have you found yourself going back to the same companies again and again? I mean, do you have a universe of companies that you are monitoring on a regular basis that you've invested in the past, maybe sold? You said you've gone from 1,700 in value line to choosing 25, for instance.
Well, it's probably more than 1,700 names because I include foreign companies and also some smaller cap companies and also some Canadian securities that are not covered. So there's probably 2,500 companies that I follow, from afar. And very quickly I'll filter out things that I don't believe fit my criteria and end up with something like perhaps 400 or 500 companies that at first glance could be interesting. And I'll go much deeper. I'll read the annual reports. I'll look at the 10Ks and try to understand the accounting and try also to understand the business. Does it have good prospects? Is it a business that is not changing too fast? Because if it changes fast, it can be good, but it can also can be left behind. Probably I end up with something like 150 names that fit all the criteria. And then, of course, included in that process, I try to judge the quality of management. Do they share our values? Do they have a long-term view on things? Do they treat, clients, employees, and shareholders the right way, in our opinion, of course? And also, I think an important part: are they in the same boat as we are? So ideally, you want them to own a lot of shares. With that group of 150 names, I'll build kind of a model of what I expect the next 5 years to be. So, because yes, you want to own companies that have a great history. Obviously, the great history have rewarded past shareholders. If you're going to be rewarded, it's the future that counts. So I try to map out what I believe will be the next 5 years for those 150 names, and then try to put a value, what I believe the shares would be worth based on those assumptions of growth in the next 5 years. Of course, the lower the price, the lower the higher the discount with the intrinsic value, the better is the opportunity. So I'll wait for a good price to purchase the stock. And sometimes I've waited 10, 15, 20 years before investing. And I'm very patient, but I think it's very important to be disciplined.
What do you think sets Giverny apart?
It's not a question of intelligence or resources. It's a question of human qualities. And those three qualities, in my opinion, needed are humility, rational, and patience. So being rational means that we try to always leave emotion aside and try to focus on the fact that when we buy a stock, we're really buying a business. So the most business-like you are in your process, I think the more rational you are. In terms of humility, I think the first thing, and a lot of money managers try in some ways to predict the stock market or interest rates, or will there be a recession soon? I have the humility to recognize I have no idea. And also humility, I think, is very important when you have to find your circle of competence. So companies that you can understand, that you can value. And there's all sorts of businesses I don't really understand. And it's okay. It just means that I won't invest in them. And finally, patience. Well, I thought about the importance of following a company for many years before investing. Well, you need to be patient, to wait either for you to understand the business very well or to wait for a good price to purchase it. And once you purchase it, you won't necessarily be rewarded the next day. So you have to have the patience for your investment to bear fruit. And I think one way that you can improve on patience is to focus on what's happening to the company. That's what's happening to the stock. So that's why we have in our annual letter what we call the owner's earnings. So we try to follow the increase in the intrinsic value of all the companies in the portfolio put together. And as long as the companies we own grow their intrinsic value, let's say by 12, 13, 14% annually, even if their stock do nothing, we know that the asset we own have increased in value. So it helps to be patient when you understand that the value of the asset you own are increasing.
Give me the name of a company that's in your portfolio now that kind of epitomizes the creme de la creme, the best of the best, and that epitomizes the kinds of companies that you invest in and want to invest in.
I would choose Visa, the credit card company. We purchased that 15 years ago in 2010. The stock had went down 25% because there were some fears in Wall Street of more regulations on Visa fees. But I think when we bought it, we paid something 16, 17, 18 times earnings. So it was a very attractive level. And since then, I think earnings have grown by more than 15% annually. So it's been a very strong performer. And still today, I think this year earnings will go 14%. I remember when I purchased Visa, I thought of a sentence I read in the book, The Money Masters by John Train. I think it was published in 1980, so it's an old book. And there was an interview with Warren Buffett. And Warren Buffett said that the ideal business is the one that receives a royalty on the growth of others. And I thought Visa was a perfect example of that. They get a tiny percentage of something 60% of all credit and debit card transaction in the world.
Right.
So it fits that criteria. I believe it's well managed. And they buy back stock on a regular basis, and so far it's been a wonderful investment.
Warren Buffett, you've mentioned it many times, clearly a hero of yours, and you own Berkshire Hathaway. And when did you first buy Berkshire Hathaway, and have you held it throughout?
Yeah, I think the first time was in 2000. In March 2000, at the height of the internet bubble, Warren Buffett was seen as someone outdated that didn't understand the new world. So I think a Berkshire stock went to something book value at some point. So that's when I first purchased it. I think we increased it because we owned Burlington Northern Santa Fe that was purchased by Berkshire, I think 2009 or 10. So we converted some shares of BNSF in Berkshire. So it was a large holding for many, many years, but recently we started to reduce it a little bit, probably half in terms of percentage of what it was 10 years ago. And the main reason is there's nothing wrong with Berkshire. I think it's an outstanding company. It's just it has gotten so big, it's much harder for them to compound that high ratio. So we try to find companies that are a little smaller and can grow their intrinsic value by, let's say, 12, 14, 15% annually. But I still think that Berkshire is one of the great companies in the world.
Some of the companies that you've owned are Alphabet and Meta, for instance. The valuations of those, are those still attractive to hold in the portfolio?
I think they're great companies. And when you think about it, the beauty of Google and Facebook is that it doesn't cost anything for the users of the products. And so really it's advertisers that pays revenues to Facebook and Google, not the users. So I think it gives them a tremendous competitive advantage. I don't see how someone could start a new Facebook or a new Instagram to compete. So they're gotten so big, and since it's free, wow, why would you change? Same thing with Google. Some people think OpenAI, ChatGPT is a threat to Google, but we could argue that it is. But I think Google has, with Giverny, has really released a very strong product to compete with ChatGPT. So I think their business model and their moat has stayed intact, even with the changing of the last few years. And if you look at valuation, it moves from one day to the other, but it's probably those two are trading close to 25 times earnings, and I think it's not a crazy price. I think it's rational.
Looking at your past performance and some of the holdings of the opportunities that you missed by either not investing because you thought they were too expensive at the time and then they, went up 900% or something, or that you sold because you thought they were too expensive. Is that one of the biggest mistakes that you've made?
Yes, I would agree with that. I think the biggest mistakes are errors of omission. So companies that you didn't buy for some reason, usually because I thought they were a little expensive, and it's been a huge winner and the stock has gone up 1,000% and didn't own it. Of course, I made a lot of errors of commission, but when you make a bad investment, let's say we lose 50%, that's costly. Let's say you put 3% in the securities and it lost 50%, you lost 1.5% of the portfolio. But if you missed the stock, you didn't put 3% in it, and then increase 1,000%, it's something like 30% or 27% that you left on the table. It's much more costly. Even if you trimmed it along the way, the opportunity missed are much more costly than the investment that didn't turn as well as expected. And worst mistake is you've owned a great company and you sold it too soon. So you identify the company as being great, and at some point you sold either because there was a little temporary problem and you lost patience and sold, or you thought that the stock was a little ahead of itself and you thought that rational way a value investor should react is to sell when full value have been reached. But it's a more complicated world than that. And so the great companies, I think you have to hold on to them. Probably the worst mistake I've made was O'Reilly Auto Parts, which we purchased in 2004, owned it for 15 years and sold it 6 years ago. And that was a huge mistake because I think since we sold it, the stock is up 4 or 5 fold. So it's been good for the 15 years we owned it. But I would say that if I kept the shares we purchased in 2004, we would have made at least 5,000%. It would have been a huge winner.
So is that what keeps you up at night? I mean, are you bemoaning the stocks that you didn't hold or didn't own?
Yes, I sometimes have nightmares about it, but you can't go back in the past. What you can do though is even if you sold and you have remorse, if everything is still intact, you can buy back the shares you sold. So really what counts is where is this company going to be in 5 years? And if the next 5 years look great and the valuation is not too demanding, even if you sold too soon or you never bought it, or you have to be very objective. And that goes back to where I said the importance of humility and rationality. It helps in making those sort of decisions to be unbiased and unemotional when you study companies. So O'Reilly, yes, I should have kept the shares. I think today the stock is pretty expensive, but if it would get to a more reasonable valuation, we could buy it back. And we did so recently. We repurchased 2 companies that we sold probably more than 10 years ago.
Which ones?
One is Brown & Brown, the insurance brokerage company. I think I sold it in 2010, so 14 years later, I think we bought it back last year. We repurchased shares of the company.
Why did you do that?
Well, there was a period when earnings, when we sold it, earnings weren't growing as fast as they used to. There was a new management that I was not sure if it would do well, but it turned out that the management did a great job. And so we decided at some point, when the price seemed okay, we decided to buy back shares, and did the same thing recently with ResMed, an Australian medical company that helps sleep apnea. We bought shares that we own, I think, from 2003 to 2012 or something like that. So we owned it for 10 years. We sold it and bought it back more than 10 years later. So, and that's an important thing to do, is to continue to follow the company, even if you don't own it. Did the same thing with Progressive. I mean, I owned Progressive from 1999 to 2005 and sold it. And 14 years later, in 2019, we purchased shares again. There was a new management, a new business plan. They really got very, very good with technology. So we thought that this was almost a new story. And since then, they've done very, very well.
Are there some areas that you avoid? You mentioned that your circle of competence, how important that is to stay within it.
I would say that anything that is linked to our resources, for instance, a commodity. So oil companies, gold companies, copper companies, zinc, steel, wood, all those companies, they depend on the price of a commodity. And I think it's very hard to predict. And they have very few control on the price of the items they sell. I think it's very hard to build a competitive advantage in those businesses. Also, there's many businesses that can be regulated. So I'm not a fan of a lot of government intervention and regulation. So when there's lots of regulations, I tend to prefer to put them in the, like Charlie Munger would say, the too hard pile.
I'm going to ask you just a couple of more questions. The one investment question, if there's one investment that we should all own some of in a long-term diversified portfolio.
Well, I think Visa that I spoke about a few minutes ago, I think it's a fantastic company. In Canada, I think Dollarama is an extraordinarily well-managed retail chain of dollar stores. And it's strong in Canada, but they're starting to be strong in South America also. So I think it has very good prospects. If you would want to own a company that I think can make it to almost any tough period, I think Berkshire Hathaway is managed in a way that they're very conservative, they're very prudent. But I think if you would want to own a company without worrying that if there's a big recession or a big crisis, you know they'll make it.
Thank you, Francois, once again, for joining us on WealthTrack.
My pleasure. Thank you for inviting me.
At the close of every WealthTrack, we try to give you one suggestion to help you build and protect your wealth over the long term. This week, we are relying on François Rochon to provide us with a recommendation. We asked him to share the best investment advice he has ever received. He, in turn, looked to a Wall Street legend from the past, Philip Carret, who wrote the investment classic, The Art of Speculation. This week's action point is follow an investment legend's maxim.
It was when I read Philip Carret's book, The Art of Speculation, that was written in 1930. There was this chapter with the 12 rules of investing, and one of the rules was be quick to take your losses and reluctant to take your profits. And I always try to keep that in mind.
Have you done that? Have you been quick to take losses and reluctant to take profits?
Yes, but I've not been perfect in that task because I've made lots of mistakes. Either not selling quickly enough or sadly taking profits where I should have kept the shares. But I try to improve on that by keeping always in that mind that rule.
Philip Carré's classic, The Art of Speculation, is a must-read for students of investing. Next week, a trailblazer in two hot investment areas will be here. Matt Hogan, an early proponent of both ETFs and cryptocurrencies, will update us on both, including his pioneering Bitwise Bitcoin ETF. Feel free to follow us on Facebook, X, and our YouTube channel. Thank you for tuning in. Have a lovely weekend and make the week ahead a healthy, profitable, and productive one.